In coming months, you will hear a lot more about the US midterm elections. Given a lot of the more abrupt policy shift that we've seen in the current administration, many investors may see this as a fresh trigger for more policy uncertainties. We think that this election is important not because it changes the economy overnight, but because it could change what policy tools are available and how quickly they can be deployed. And that matters for the path of fiscal decisions, debt ceiling dynamics, and also the balance between the legislative branch and the executive branch. Our objective in this episode is not to predict where the elections could go, but rather consider the possible policy shifts after the midterm elections and what tools are available for the Trump administration for the rest of the current term. Welcome to Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management, and thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So let's start with the basic. On November 3rd, all 435 House seats will be up for re-election, and 33 out of 100 Senate seats will be up for votes. A key backdrop here is the historical pattern. The president's party has typically lost House seats in the midterms, with notable exceptions in 1934, 1998, and 2002. And therefore, history is not really in favor of the Republican Party, which currently only has a very narrow 4-seat House majority. For the Senate, the election map is more favorable to Republicans, and in the 50-50 Senate, the vice president holds a tie-break vote. So putting these together without looking at opinion polls, you can see why market frames the midterm elections primarily as a question of a shift in congressional control, especially the House, and what that implies for legislative throughput. For investors, the potential shift for the House from Republican to the Democrats is relatively simple. You could see a greater degree of legislative gridlock in coming years, and this can reduce the scope for large, fast-moving legislative shifts, and there are several areas to watching out for. For example, fiscal constraints and how binding they could be, and the likelihood that more policies attempted through executive actions rather than statute. Now, when one party controls both chambers of the Congress, many fiscal policies could be pushed through via budget reconciliation. And this becomes a central piece for pushing fiscal policy through. An important reference point in this discussion is the 2025 One Big Beautiful Bill Act, which highlights how budget reconciliation can matter when legislative control is unified. Back in 2025, under OBBBA, the debt ceiling was raised by $5 trillion to $41.1 trillion, and it is estimated that we could reach that debt ceiling by 2027. Now, in the case of a divided Congress after the elections, what you could see is a greater degree of bargaining between the Republicans and Democrats to raise the debt ceiling in 2027. Eventually, we think that they will raise the debt ceiling, but the political posturing can keep bond markets on edge, especially as deadlines approach and messaging hardens. The immediate policy implication is that it will be harder for the Trump administration to pass fiscal stimulus through budget reconciliation under a divided Congress unless there is a significant deterioration in the economy. Now, that framing is particularly important for markets because it ties election outcomes to a feasible set of fiscal actions. Now, even though we may not see a lot of fiscal stimulus in a divided Congress, at the same time, a significant decline in deficits is also unlikely. There are a number of constraints. Now, there are real spending pressures. For example, munition replenishment, but also a broad range of social security, healthcare, education. These are very difficult to cut. And meanwhile, there's a potential revenue loss from legal challenges towards President Trump's tariffs. And also don't forget, a notable part of the overall deficit is being driven by interest expense, not the primary deficit, which is the difference between revenue and spending. So even as the political configuration changes in the legislative menu, it does not automatically create a clean path to a meaningful deficit reduction. On trade and immigration, a divided Congress still points towards the executive action channel as a key transmission mechanism. While the Supreme Court may have ruled that IEEPA tariffs were unlawful, the Trump administration is pursuing tariffs via a different pathway, for example, Section 232 and Section 301 of the Trade Act to investigate whether trade partners are engaging in unfair trade practices. Immigration is another major lever. A restrictive immigration policy can limit labor supply growth, which becomes relevant to the macro backdrop through labor market and capacity constraints. On foreign policy, this is also a reminder that the executive discretion remains significant, even though in theory, congressional approval is needed to start a war. Finally, on regulation, the key takeaway is that the regulation may not shift dramatically through sweeping legislations, but the Trump administration could still have significant influence through agency rules and also enforcement priorities. So, what does this all mean for investors? First, plan for a window of volatility. Election uncertainty can raise volatility into the votes, and it typically fades post-results. The portfolio question isn't whether volatility appears, it's whether you've already pressure tested liquidity, rebalancing rules, as well as risk limits for that window. Second, separate legislative risk from executive action risk. In a divided Congress, fiscal stalemate can actually be supportive for long-duration government bonds. But the same gridlock can increase the importance of executive actions, particularly in trade and immigration, because that's where the policy can still move without going through the Congress. Finally, keep your expectations on regulations relatively grounded. Regulations may not shift dramatically, and the practical levers are often agency rules and enforcement, plus supervisory frameworks. For portfolios, this argues for monitoring the direction of implementation, not just the direction of rhetoric. Active management is crucial to appreciate the potential impact on sectors and companies. Ultimately, the economic backdrop matters the most for market performance than the precise outcome of these elections. What's happening in the energy market, the development in AI, and the outlook for monetary policy are arguably more relevant to portfolio construction. Nonetheless, we'll keep everyone updated on this race in coming months. Now, our thoughts on the midterm elections is actually part of our 2026 mid-year outlook paper that will be released on the 15th of June. Alongside with this discussion, we're also sharing our insights on AI development, opportunities in China, how the situation in the Middle East could evolve, and also prospects of alternative assets. Look out for our mid-year outlook in your inbox, or reach out to your JP Morgan Asset Management client advisor. You can also, of course, get this paper from our website on the 15th of June. So thank you for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. Meanwhile, if you have any questions, feel free to reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in our next episode to discuss what's on investors' minds. Meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors, may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.